So the data is certainly more positive than we've seen in a while. But it is still very much in line with what we've been seeing in China for some time, which is some parts of the economy are still a little bit on the weaker side. Some parts are seeing a pickup. So for us, the data that we've seen on Chinese PMI is very much in line with our expectations of a broader pickup and a broader recovery in the manufacturing cycle, especially as we head into the second half of the year. But it isn't sufficient for us at this stage to drive a more positive stance on China itself. And for that, we would really need to see the government addressing taking a much more aggressive stance with regards to stimulus measures and really taking a more focused stance towards real estate and the issues that the economy is facing there.
Indeed, still so many concerns regarding the outlook for China, and one data point does not make a trend, so we'll have to look at the numbers moving forward. Fahd, let's shift it over to what's happening in the United States as well. I know you are following this number closely over the weekend. It's the Fed's preferred inflation gauge, up 0.3% month on month in February. I guess the data ultimately confirms that Powell and co. are still in no rush to be cutting rates anytime soon.
Absolutely. It still remains a very data-dependent process, so obviously each data point is being watched carefully. We are of the view, in line with the market, that there will be 75 bips of rate cuts this year starting in June. But the bias and the risk on this is very much that we see fewer rate cuts occurring later than expected. And so from that perspective, your non-farm payroll numbers later this week, inflation readings are going to be very carefully monitored, because any signs that we're seeing inflation remain elevated, more elevated than expected, will create a scenario where it will be difficult for the Fed to really cut at the time that we expect. So if we continue to see inflation being elevated at the levels where it is now, we could well start to see consensus expectations moving towards fewer cuts. That's not really our core scenario.
The headline data point.
That we're keeping an eye on.
Right. Fahd, the headline data point for the week ahead, I think it's important just to mention this, and you said this as well, it's the non-farm payrolls report, but also the U rate due stateside. What should we expect from those numbers, and could they be, for want of a better word, a game changer for the Fed?
Well, for us, the labor wage earnings and the non-farm payroll numbers are going to be closely watched. Unemployment is obviously something we monitor, but we don't think that will be a figure that really drives an inflection point of the market or in expectations. The consensus is looking for 200 for the non-farm payrolls. And if we see a significantly higher number than is expected, as we've seen many times in the past, that will start to weigh on expectations a little bit. I think what will be the bigger concern, perhaps a bigger driver of any change, will be wage inflation. Now, the labor market has been cooling for some time now, and if we continue to see signs that that's very much the case, then I think consensus and our expectations will remain for those 75 bips rate cuts starting in June. But those would be the areas where we would really be keeping a close eye.
Okay, and Fahd, just before I let you go, anything else you're watching out for in the week ahead?
For us, it really is very much a focus on economic activity. If you look at the way data has been coming out, this year is holding up a lot stronger than expected. And central banks in general are expected to be almost in unison, at least within the G10, conducting rate cuts starting around June. So any signs that economic activity is more broad-basically stronger than expected, any signs that inflation is holding up better than expected, is going to be weighing on central banks' ability to cut rates. And like I said before, while I was specifically mentioning the U.S., I think the case holds true for the broader G10 market. The risk is very much that we see a later start to that rate cutting cycle than earlier.